Okay, apparently we're live now, so.
So welcome everybody to today's episode of the Real Estate Lab, where we dive deep into the latest updates and trends shaping the real estate market. Today, we've got a power pack panel of experts with us. We got local realtors, we have a residential mortgage lender, and we're going to break down what's happening on the ground in the Austin market and beyond. Because what's going on these days is the Federal Reserve's recent interest rate cut, I believe, has been the first since 2020, and that's shaking up things for home buyers, sellers, and investors. And Federal Reserve Chair Jerome Powell also hinted at possibly more rate cuts to come, signaling potential shifts in borrowing power, essentially affecting affordability and demand. So we'll talk about if inflation is cooling and what's going on here locally in Austin. What does that mean for you and anyone looking to buy, sell, or invest? Let's start with Sarah.
Yeah, hi everyone. So thanks for having me on. It's been great because we're finally in a rate cut cycle, which is amazing. So we've been waiting for this for a long time. I know it was anticipated to start originally earlier this year, May, hopefully March, and that just didn't happen because the Fed didn't see the numbers they were wanting to see. But now, after the 18th, the Fed cut 50 bips. For the Fed funds rate, and now they're anticipated to cut.
Hold on, Sarah. Can you explain bips for the people in the back?
Yes. So 50 bips equates to half a point. So
which equates to what in dollars or an interest rate?
So half a percentage point. So as far as mortgage rates, though, a lot of people get it confused because they think Fed funds rate is directly correlated to interest rates. So some people thought, and a lot of news resources were posting this, and it's not correct, is that when the Fed does any rate cuts and the Fed fund rate gets reduced like this time by half a point, 50 bips, that automatically means mortgage rates are going to be reduced by half a point. So let's say that you were looking at a 6.5% interest rate, and now you're looking, then they think, oh, now it's going to be 6, because that makes sense when you're just seeing something on the surface. But that's not how it works. The Fed fund rates indirectly affects mortgage rates. What the Fed fund rate is, what those interest rates are, is the interest rates that banks use to lend to each other, and it affects short-term debt. So you're going to see an immediate impact on like credit cards, car loans, business and personal loans, things like that. And then that all affects the bond market, which is what affects interest rates. So the nice thing is that based off of what Jerome Powell was saying, and the Fed came back with what their projections are for the rest of this year, is that they're projected to do 2 more 25 BIP cuts, one in November, one December, meaning another total of 50 bips or half a point by the end of the year, which should indirectly help mortgage rates go down a little bit more.
So an entire percent by the end of 2025. They could have just said that.
Well, end of 2024.
Oh, 2024. Right, 2024.
Yeah. In 2025, they are looking at an additional 1% cut by the end of 2025.
Okay, so 2% by the end of 2025.
Yes.
That's the writing on the wall. On
yes,
the invisible bank. Got it. Okay.
How solid is that? Do they is it accurate? Is 80% probability?
So they don't give probabilities. Basically every other, so like when the Fed comes out, Jerome Powell comes out and he does his little speech to let you know what they talked about and where they feel that where the Fed's going to move with policy, if there's going to be rate cuts, things like that. So every other meeting and every other time that he speaks is when the Fed forecasts happen, and when he talks about when the SEP comes out. So, and that's this last one on the 18th, that's when they said, hey, this is where we predict Fed, like the upcoming cuts to be. This is what we predict for 2025. And so that's just based on the data they have today. Obviously, that can change depending on what happens in our markets. I think the main thing is the Fed's very concerned with there being a possible recession. and they want to make sure that they're not still being overly restrictive where it's hurting the average person in American, and then they go into home buying as part of their reason too. But again, not 100% certainty. That's just the most likely of projections based off what Jerome Powell came out with from the Fed meeting back in September.
Gotcha. So this is based off of all their meetings.
Yeah. So in not November, but in December, we should get another projection from them.
So this kind of goes out to everybody. Do you think this is a better thing for Austin?
And I would point out Austin's been in its own stratosphere. It's
I know, that's why I'm asking that, right? Because we're different than the rest of the world. Or sorry, rest of the US especially.
I'll go.
Go ahead.
Real quick. I think if Austin can learn to act right, it could be positive for us. There's just so many things that are not.
Did you just call us cray? What does that mean? Learn to act right.
Austin's a little spoiled brat. Well, it's we've got so much inventory, and I think yes, obviously interest rates have a humongous effect. But the fact that we have so much inventory, all of a sudden everybody decided to sell their house. Our inventory literally went up 100% from 2021 to now. That's mind-boggling. So, and I'm sure you guys are seeing it. All of us are seeing it. It's buyers will get approved, and then they'll look and look and look and look and look and look, and they'll keep looking. It just people have the time now to really take their time because there are so many options. So what I was saying is, if Austin can act right, in the sense that we just have so much inventory.
So when you say Austin, are you talking about the people of Austin, not the city? You're talking about the people.
I'm talking about the market.
Got it.
So I don't really know who I'm talking about.
I think I know what you're saying. This is what I interpret it as.
Yeah, go for it.
I see sellers. It's kind of the brat thing is like a stubbornness. There are sellers, and maybe we're talking about getting transactions going, and people can move the way they want to move. They want to own, they want to leave and sell. So I think sellers, I call it the 2021, 2022 hangover, where sellers still want that price, and buyers do see a lot of inventory. So they're also I don't really want to, offer that high, or I might not offer at all, or I'm just going to sit on the sidelines and not offer anything and just be a looky-loo. So the inventory has been building. So that's what I took from brattiness or non-transactions, no movement. Because a lot of people are stuck with homes that they don't they're trying to move. Not everybody wants to keep a vacant house.
Yeah.
I kind of see it as kind of dual forces. So one, you have sellers that don't want to sell for less than they feel it's worth. But I think a lot of that is because of either A, what they bought it at, or B, if they ended up getting some kind of loan or some kind of into a situation where they're tied in, they can't let it go. They don't want to let it go for less than they owe on it. Right? Nobody wants to be upside down in the property.
There's that.
So when Amazon and some of these other companies were like, hey, Dell even just said it, you got to return to work. Well, now that it forces this adjustment in your life. So that's one side of it. The other side of it is people were holding out, especially people that had great interest rates because they bought during the pandemic. They were holding out. And so now we're starting to see a trend where rates are starting to decline, but people have some kind of imaginary number in their head, like baseline, before they're willing to say, okay, now I'm ready. And I don't know what that is for so many people. So just like you said, Daphne, we've got a lot of inventory in Austin, and we have declining interest rates, not drastically, but it's moving over the next, over the next couple of years. We know it should be going down. Should be. We have this really weird election. We have dock workers now that are striking, and that's going to create a supply chain issue, right? We have return to work mandates, and Austin is kind of in the middle of all of those things. So it's going to have an effect. The question is, how is it going to affect us?
You want to take a look at stats?
For a minute.
Did y'all want to look at real estate pricing stats?
Well, I want to hear what Daphne or Sarah had to say first before we jump into those. Excuse me.
I was just going to say that I think it does help people that do feel locked in. Like if you have people that feel locked into those homes, those mortgages, like you were saying, and now rates have started to decline, so they can rationalize moving again without the prices being astronomical or mortgage payments being astronomical. So I think that's definitely a plus. I think right now we have a really interesting window. I've had buyers that have been able to buy homes, get amazing deals on homes that we haven't seen in a long time with all the price reductions. I've had clients buy homes under 300,000 that are not fixer-uppers, that are nice homes, and that are actually getting, I had one last week that are getting 11,000 in seller paid closing costs. And so they're getting everything covered in a really good monthly payment they're comfortable with. So I think before rates fall more, getting more people off the fence and starting to get people to buy, be more okay with buying, I know Austin's been, having more inventory than most in the country because of all the things that have already been mentioned. But I think it will cause more competition. And I think cause purchase prices to probably go up and be more competitive, and less seller paid closing costs probably will be not as much being able to be negotiated. So if you have a lot of first time home buyers or people that, really need to negotiate those extra things, I just feel like right now is a really good opportunity for that before we do see the switch and have more people coming and like getting off the fence and buying from these.
So like real world example, I've got an off-market listing. It's in Georgetown, like kind of where Leander and Liberty Hill all touch in Georgetown. We're talking almost a 4,800 square foot house for less than $70 a square foot because the person needs to sell it. They just need to sell it. That's insane. We haven't seen, that is, if you're looking at price per square foot, we're averaging 200s, 300s, 500s in some places.
How much is the house? I just did the numbers. It doesn't make sense. How much are you guys asking?
How much are you offering?
336. So my math isn't mathing.
Sorry. It might be 150 a square foot. So it was
700,
4,800 and we're asking 615.
Okay.
615.
Georgetown, yeah.
That is a great deal, though.
That's still incredible. It's like half of what some of the others are going. Yeah.
120. We'll call it 130.
Yeah.
Okay. Cool.
I was like 70. That you said that, and I thought, that's way off.
Yeah. Like,
but yeah, like just insane deals. I can't even get it out. Where do you buy a 5,000 square foot house for that price here
in Georgetown?
Other than that,
Leander, Liberty Hill.
Not at that price though.
Definitely not. That's really crazy. I'm assuming turnkey.
Maybe a little paint.
Okay, but she's good otherwise.
Yeah, it's crazy. So, but that's the kind of thing. I only bring it up. Well, one, shameless plug, but I also bring it up because that's the kind of thing that is happening. There are these deals to be had because of the inventory and the mandates and all the stuff that's happening in Austin that people aren't taking advantage of. And they're like, well, I'm going to wait a little bit longer until the rates drop.
That's what hurts people. Like I still talk to people that were like back in 2022. They're like, 5% interest rate makes me very uncomfortable. I'm going to wait. And then they waited and then we got up to 8s. And it's like, if you hadn't waited, if you just took the plunge, but I would never pressure anyone to make the deal, but if you're always going to wait for the perfect time to try to time the market, it's almost never going to happen.
Yeah.
I think the unfortunate thing is that people have been hearing real estate agents specifically saying this for many years. Real estate agents and mortgage professionals saying it's always a good time to buy or it's always a good time to sell. And the truth, and we say this often, is if you don't need to do it or don't want to do it, don't do it. But it is always a good time for someone. That's the real truth. And you just got to figure out if you're that someone in the moment. Someone's making money. Houses are still moving. All right. Yeah, let's talk about stats, JJ.
Did Daphne, you have something to say?
Oh yeah.
I think I've mentioned this before. But I always tell clients, like my home buyer clients, and I'm very honest with people, extremely honest. And they'll say, like, is now a good time to buy? And this is something I've been saying for years, but it's like, now will always be the most expensive time to buy. Whether it's because of pricing or because of the interest rate, whatever, it's always going to feel very expensive. But 5 years down the line, it's like, oh, well, I did something. I invested something somewhere.
So I don't have children, but that's how I hear people say it, right? Like I always thought if I'm ready or when I'm ready, then I'll plan to have kids. But you talk to any parent ever, and they say it just happens and you're never ready.
100%.
And I think that this is like that. I can only try to empathize, but I think it's like that.
Sarah?
Yeah. I have 3. And yeah, I mean, I completely agree with that. It's one of those things where you're happy in retrospect when you take that plunge. Like I remember I had a family member that pushed me to buy my first home at 26. And I was like, oh, that was just the last thing on my mind, but I did it. And I'm so happy I did. It became an amazing investment property. And, it was like back when you could get a brand new home in South Austin for like $190, $200, with a 3% interest rate, but at the time that was a lot. But then now, like exactly what Ian said, it's the best decision you look back that I ever made.
Yeah. And some of it's like simple economics. There's obviously pros, there's obviously cons. So yes, you don't want a high interest rate, but price wise, all the inflation's gone. Guaranteed. No one's trying to there's no frenzy. The price is the price. It's not going anywhere. Like nobody is going to pull the trigger on a price interest rate.
I mean, hold until the strike is over.
Yeah. What I'm saying is if you buy now and you close or, you can negotiate with the seller, and that's probably as low as you could get it because no one else is behind you trying to make another offer. So you could lock that in. This is the pro, obviously. You could lock that in and then refinance. And we're talking about refinancing options throughout the year, if not 2026. So there's a give and take. Or you could play in the frenzy and all that stuff too. Okay, let's look at the stats here. So I have, let's do the screen share. The Austin Board of Realtors, Austin, Round Rock, San Marcos stats, very broad. This is kind of greater Austin area, north and south. You got median sales price going down here, 439,990. Closed sales are down. Sales dollar volumes down. So this is year to year for August. Inventory, like we talked about, is up. Listings are down. Active listings are up 15.4%. Pending sales are up. Average days on market up.
So look at this number. For people that are talking about that were waiting to buy a house, active listings, there are 12,000 active listings. Buy a house. If you wanted to buy a house, and if you're ready to buy a house. But come on. Where were we at before? 2 years ago, where were we at?
I have another Austin Round Rock MSA. This is interesting. This is Austin Round Rock MSA year to year in August. And you could see it's going down every year. Closed sales going down. Average days on market going up year to year. Active listings shot way up. 2022 to August 2023 looked a little flat, even though it went up a little bit.
Yeah, I want to see the 2020 numbers in 2021.
Me too. I'm trying to find them too.
A whole nother thing.
But also look at how many billions are moving.
Yeah. And
still
then
billions of dollars in sales happening every month.
Yeah, there's still transactions.
Sarah, do you think the billions are going down because of the interest rates?
I think that the billions are going down because that's total sales dollar volume, right? Okay.
Right.
So, I mean, I feel that we're probably going to see that start going up. I feel like it's gone down because sales prices have gone down, and that people and in the combination of interest rates going up and people not buying as much. I think it'd probably be a good combination of the two. But I really do think, granted, I'm not on y'all's side, but I think that we should start seeing a turnaround on that this coming year.
I have a bit of a turnaround stat. Okay, so this is very Greater Austin with Austin, Round Rock, San Marcos. If I scroll down, you notice Bastrop. Again, there's still affordability. It's just on these outer counties.
Yeah, yeah.
300s, right? Caldwell, even high 200s.
Quick question.
Check this out. City of Austin, a little uptick here at 585,000 by a 1.8% year to year.
Now that you say that, I actually had a couple clients recently reach out that had bought during, between 2020 and 2022, but now they're having to go back to the office. And so they had originally bought in the outskirts, and now the commute is way too much for them. So they're wanting to convert those to rentals or sell, and then they're trying to move closer to downtown Austin or North Austin because that's where their offices are, and they have to start going in, and they can't stand the commuting and the traffic. So that could possibly be a reason of more people moving to Austin proper.
Yeah, that makes sense.
I just found this same graphic for, I want to say is it August? Yeah, it is August 2021. Can I share it on the screen?
Yeah, let's take a look.
Okay.
See this trend
Just
here.
a moment. 1 second. Yeah, all right. Let's show her. There we are. So this is the same area, Austin, Round Rock MSA. Median sales price. This is August 21. So in the heat of it all, there it is. So prices were a little bit lower, technically. Let's go to inventory. Where was it? Okay, active listings. 3,300. We'll call it 3,400. And what did you just show on yours? Like 12,000?
12,300.
Bananas. Yeah. Inventory. 1 month's worth of inventory. That's wild. Wild, wild, wild. And look, it went up, the home values went up 34% from 1 year to the next. Bananas.
So nuts.
Yeah.
So we quadrupled.
Literally. Literally. So actually, I just did a video last week about that infographic that you shared, JJ. I didn't have this in the video, but yeah, it is really interesting to do like the month over month, year over year, and take a look.
So here becomes the question. The question is, with the interest rates supposedly dropping 2% in the next 2 years, the inventory is currently at 12,300 when the interest rates were extremely low, like the lowest they've ever been. We were at 3,300. How long do you think before we're at parity, or how long do you think before people start getting a little crazy again?
Well, with the Fed fund, the 2% is the Fed funds rate, interest rate, not the mortgage interest rates, right? So I think if we put that into perspective, if we see the 2% drop in Fed funds rate, then we're probably seeing mortgage rise like in the low fives. Okay. So I don't think we'll ever get to the frenzy that we saw when rates were at historical lows of like 2%, 1%, 2%, low threes. But people have been waiting a long time. So I think it'll definitely be an uptick, but I don't think it's going to be as crazy as it was before, at least in my opinion.
So Cajun Crypto says they can't afford them now. The market is about to crash. I want to hear what people think about that one.
I do think they can't afford it. That's why they're sitting there. So you're right on that. Crashing. I mean, I'd like to hear some numbers, right?
Well, we've heard the market's about to crash since
Since 2012.
Yeah, I was gonna say 2010, I think is when
I've heard that since
after
then.
it crashed. We heard it's gonna crash again. It's like, well,
2008 was the crash.
Yeah.
Prediction, which actually was a very resilient time for Austin, but Austin was
For Austin, right? Because
boring.
we were a little different.
Yeah, we were different.
Do you think we're protected this time around?
No, I think it wasn't just interest rates for Austin. It was also industry. And now I feel like we're in the speculation of tech, right? Like, I don't know, a couple AI companies. I mean, I don't know what more can happen here, but I didn't know Elon Musk was going to come here. And I think that.
Well, we have a lot of manufacturing. Not only do we have Samsung manufacturing, we have a Google plant. Apple's manufacturing is doing return to work. Dell return to work.
Yeah.
There's a lot. We have a lot of silicon producers. A lot of, like I said, so chip manufacturers, automobile manufacturers, the number one United States-based automobile manufacturer is right here. We have rockets, for crying out loud. We have a lot.
Yeah.
And it's also a question if the industry is that stable, is it that resilient? You know, like New York City, if I'm correct, might be like a finance city, and sometimes finance is up and down, right? You have like a Detroit, which was at the time like a car, mega city. San Francisco, Austin, Seattle, tech cities. Is tech a resilient industry? Does it keep growing? Is that where our future is?
I think that's the thing, is that we don't have all our eggs in one basket, where a lot of these other cities did. Detroit was only cars. It's all you ever knew it for. Yeah. They happen to have other things too, but it was mostly cars. We do have tech. We also have manufacturing. We also have
behind the tech. It's kind of techy. Like, it's very
well. It doesn't matter what you're manufacturing so much, I guess, right? Because
I thought they came here. I don't know. I'm like, are they coming here because Teslas are being built and they could ship stuff like Samsung? And I don't know how they will like intertwine.
We're a kind of a hub for crypto. That's a conversation, right? Especially if things do actually crash. We have A&M.
Is that a basis for economy now?
It is when you think about farming and agriculture.
You're talking about A&M, the university?
Yeah. So you think about A&M and you think about UT, and you think about the industries that they focus on and they produce.
Yeah.
Why are they such popular schools?
I think they're although I'm such a UT fan, I'm thinking about these.
Okay, but great. Why? Right. What are UT's top programs right now where companies will be hiring from those programs here?
Yeah. Like, I think Silicon Valley had that Stanford kind of like thing going on where you get the new blood, they feed the industry.
Yep. That's all college towns are. I mean, that's a big deal. They want to keep you here. So what are the students they're keeping here?
I do still think it's tech. Like, if something happens to tech, then that's the viewer's call.
So their top programs are McCallum School of Business, which I think is always
startups. Perfect.
Always, yep. Mm-hmm. School of Engineering.
Great. We have a lot of engineers. It doesn't matter if it's tech or anything else.
Keep going. Get those engineering degrees, y'all.
Computer science, and number 4, semiconductor science and engineering.
Okay, so those last 2 are tech, and 3, the engineering is probably tech too.
Yeah, I mean,
and business is startup tech, so it's fine. But
more finance would be good. I don't see enough finance around here.
Didn't UT just
Dallas? Sorry.
Oh no, I was like, and UT, I think this last year has one of the first like AI graduate programs or something like that, which I thought was kind of a big deal. So
it is. I think it's a big deal.
Oh, even unofficial. It's not necessarily a master's degree. I was looking into this. Y'all want to get an AI certificate from UT?
Yeah, I get those emails as a grad.
So Now A&M, let's go back to A&M, which is depending on where it is, because it's kind of sparse, right? But we have facilities and spillover into Austin. That's what's important, right? We have biomedical sciences, psychology, mechanical engineering, which is fantastic, right? Communication, education, and sales and distribution and marketing operations, health and wellness, animal sciences, all your HEB meat and farm to table restaurants. Like these are all the industries that we're impacting here. Dell medical. I know that's not A&M or UT, but not directly.
Do you want me to read you a list from A&M, their top programs?
Yeah.
Well, I mean, I guess I'm just trying to make sure that we understand that the industries that are supporting us are not just tech, where the rise in Austin at COVID was because of the infusion of so much tech into Austin.
Right.
But we were already here. We were already growing. We just weren't crazy with it. Like it was just a light glide upward.
And that's why I think Austin has, like you said, has always had like a stable market and stable housing. We never saw a crash. Like even when we were back in, 2000 and 2008, like we weren't hit very hard because, and to your point, it makes sense if we have a lot of those markets that have been here for a long time that maybe aren't highlighted or we don't first think about because they've been here for a while, kind of holding steady. Does that?
So Daphne, with the ones that are at A&M, are those sustainable?
Mm-hmm.
Like, what do you see those changing a lot because of interest rate politics, things that are happening?
I don't know enough to say on some of these, and I'll just tell you real quick what they are and why I don't know. So engineering is their top one, business is second, like UT. But then 3 and 4 are veterinary science and then agricultural and biological engineering.
Beautiful.
So more farm and animal related. I know nothing about those industries.
Yeah.
And what was your question? Are they going to change? What? Tell me.
Well, so do you think that if we were to remove tech, let's say Austin was no longer an exciting place for tech,
mm-hmm.
do all the other industries make a great economy in Austin?
Great economy in Austin? No, I mean, we don't have a strong farm base. There are farms here, but that's not what we do.
Well, we still have manufacturing. It's weird because, like JJ said, tech is kind of infused with a lot of this stuff.
Yeah.
All the startups are
tech
tech.
Company, or is it a tech company? And it's like kind of a tech company.
It's an energy company.
It's an energy company, or is it like a battery? Is it lithium? Like, what is going on?
Just energy. It's an energy company that happens to make cars.
Is it social media and X?
That's coming too. That's a separate company, though.
Yeah. Yeah, I think, and that's the thing about this price point is techie to me. Like the more we talk about agriculture, I'm like thinking about Waco's stability.
Well, so that's actually a really interesting point. So we just passed, or at least Austin proper passed, where you can now build 3 homes, right, on one lot to help with pricing. So that's part of the conversation. When you look near Taylor, where the Samsung plant is and where the new Google plant is in Hutto, the Google manufacturing or storage facility, we're talking $200,000 to $300,000 homes. We're not talking $600,000, $700,000 homes.
I like the idea of newer construction. So I think the concepts that we're talking about is there's a fairly resilient economy, tech, and some diversity. And there's still people probably wanting to live here. And there's, I think, statistically jobs here. Affordability is an issue. So if you get in on new inventory in the right place, especially in the density spots, then I think that's a good opportunity. Because all those things aligning sound like a good time to get something again, kind of depends on the price, but if it's a price that you're comfortable with.
And they just approved, so Project Connect is moving forward with a large approval. So for all the rail systems, and we have our airport, which just moved forward with another large approval. So by 2027, I think one of them is breaking ground in 2027. But the point is, everything is expanding, but not at an egregious rate here in Austin. So I think we're good. I think we're good. I think there's some tech that left.
Yeah, Austin Round Rock MSA in the 400s. Strong Texas City.
In between all the others, you know what would change it a lot is if we had transportation to San Antonio and to Dallas and to Houston.
Mm-hmm.
Yeah,
like
I will say
bullet trains. I'm talking like something fast,
huge,
like a rocket.
Yeah, yeah, or a tunnel underground or a bullet train. I don't care what it is. I just think it makes so much sense. We have the technology. It's all political at this point.
100%. Got to use your truck to get there.
There's a little bit of there is some residual economics from Houston and Dallas. I think San Antonio.
Yeah, but imagine if you could work in Dallas and live in Austin. What would that look like? That would look like 2021, right? Because that's what people were doing. That's the only limiting factor is the travel time. People that are in Seattle that moved here, they moved here because they could work remote and still get paid the Seattle money. So if we had a transportation between Dallas and Houston, if we could get to and from in 10 minutes, which we can, but if we could do that, or if we did that, that would change our landscape a lot.
And even on the same token, when we looked a little bit at the stats, some of these outer areas are in the 200s, 300s. I have a brother-in-law that works at Oracle, and he lives in the Clean area, Clean Copper Cove.
What?
And he comes in like once a month into Austin.
Oh, okay, once a month. Okay,
something like that. But he lives there, but he's getting Oracle money, and I'm like, that's a good setup.
That's the perfect setup. That's why we had such an influx of people here.
And you could do it. Like he goes to Texas football games. He shops at the Domain. His family comes up here a lot, but his housing costs way more affordable than what we saw in the 500s for Austin proper.
Yeah, absolutely.
It comes with its own.
A little bit of a drive.
And a genius for him.
Depends on your monthly.
All right, what were we talking about? Interest rates? Fed rates?
Right. I think we're talking about like opportunities with interest rates. Do you think there's like any interest rate strategies that people should be aware of? We talked about
Wonderful question. Wonderful question.
Yeah. I think right now that as far as looking at interest rates, if they want to buy now, right, and they're just figuring out what's the best thing that they should do as far as strategizing for their loan, I think it would make a lot of sense, unless they have to have their monthly payment at a certain amount, to not buy points with just the projection of rates going on a downward trajectory. Because if you buy points, then that goes away, right? And you need to see what the break-even point is.
Can you explain the concept of buying points? Because not everybody was buying houses during COVID.
Of course. Yeah, no, that's a great point. So essentially, every pricing for interest rate pricing is on a grid. So if someone says, oh, this is par pricing, that means you can get an interest rate with no cost to the borrower. Like you're not paying any money for that interest rate to buy that, to get that loan. But you can do something called buying points, which means you're paying money to get a lower interest rate. And so 1 point is equivalent to 1% of your loan amount. So you could say, okay, I'm going to pay a point to get this lower interest rate. So what a borrower does, or what I choose, what my job is that I look into that and say, does it make financial sense for this borrower to do this? What's the break-even point? Would you have the home long enough with that monthly payment savings to pay yourself back that investment that you made?
Can we get a quick hypothetical on a $500,000 home? What does it cost to buy a point today? Nobody's holding you to the number, just like an average.
Oh, sure. I mean, it's going to depend on how much money you put down. So let's say that your loan, you said $500,000 home or loan?
Home.
Oh, okay. So let's say that you have a $500,000 home. You put, I don't know, what are you guys seeing? Like 10% down on that? Okay. So if you do 500,000, you're looking at a $450,000 loan. So that's gonna be $4,500. So you would be paying $4,500, which is 1 point, to get your interest rate down. Typically, what I've been seeing is you getting into maybe the high fives with that. If you're looking at a 30-year fixed rate loan with, excellent credit and things like that. That's typically what I'm seeing today. But granted, there's like 26 different things that affect a interest rate. So that is, I'm not quoting anything. I'm not promising anything. That's just on average what I've been seeing lately. And that's the thing actually that I've been seeing a lot of, where I've seen a lot of advertisements. I've seen things on Bankrate. I've seen loan estimates come over where people are like, oh, I'm getting this like 5.5% interest rate with no points. It's amazing. But what's starting to happen again, which just happened pre-2020, is that instead of charging points, people are charging origination fees. So you'll see lenders start charging a 1-point origination fee on top of their other costs and fees. So they're really paying that point, but in another way. So it sounds really great because a lot of clients and sometimes realtors are trained to be like, are you paying points for this rate, to try to help their client? But now there's lenders out there that are just doing it in another way. So they're really paying that extra money, but it's just not called discount points. So that's something to look at.
You're saying is the origination fees going up? Is that what's happening?
So this is going to differ by lender. So some lenders or brokers will choose to charge a certain amount for an origination fee, and on top of their underwriting fee, processing fee, all the other fees they typically charge. And what I've seen lately is that be about 4,000 plus or 1%, 1 percentage point. So really they're paying those additional costs to get that lower rate, but it's just being presented in another way. And if you're a client or a first-time home buyer, you're not going to know to look for those things. And it's not something you're going to actively look for, because everyone talks about what's the cost for that rate. So that's automatically where your head goes. So unless you have someone that knows to look out for that, or, compares and explains that to you, it's not something you're going to pick up on right away or at all.
That's interesting.
So are you advising them to cross-reference with another lender?
Yeah, just transparency. So I think that's the thing, is make sure that, because what I see a lot of clients get into this is that they'll go talk to a couple different lenders and they'll just ask like, okay, tell me what your rate is. Tell me what your rate is. Am I paying points? And they don't get any other information. So they don't know what the total fees are that are associated with getting that mortgage or that loan, instead of getting like a full worksheet and having that conversation. So when you have someone shopping and that's the only question they're asking and the only information they're asking for, they're not getting the big picture. And it's because they don't know to ask for that. So I guess if anything, my advice is make sure you're not only asking for rate, and if points come with that, ask for an actual worksheet where everything, or an itemization fee sheet where everything's broken out for you, so you can see what the actual total cost is you're paying for that home. And that way you can say, oh, well, my cash to close here with paying no points is like 85,000, but my cash to close here paying a point is 80,000. Why is that the case? And so it allows you to ask better questions.
Sarah, do you think it's important to get these fee sheets at around the same time?
Yes, thank you, Ian. Yeah, that's really crucial, because interest rates, they change with the market. So they can change hourly, they can change daily, especially with how volatile they've been over this last couple of years. So it's really important to do apples to apples to get everything on the same day if you can.
And do you feel like a lender that won't give you a fee sheet is a yellow flag?
Yeah, yes. I think that if someone will not give you a fee sheet or give you something that breaks out all the costs for you, you should ask yourself why. Because I can't speak for everyone, but I know my big thing is transparency, and I want everyone to know like what their monthly payment is, how much out of pocket they're going to pay, because that's huge. That's what you're making your decision on. And if you don't have that information, and you don't have the full picture, like how can you make an educated choice? So if someone's not willing to give you that information, then I would move on to someone that will. I would ask them why, just out of curiosity, and then probably move on to someone else that will give you the full picture and all the information you need.
Awesome. So be conscious of fees, question it, look at the fee sheet. And you mentioned don't pay for points right now because the interest rates are going down?
Yes, sorry. So to finish that thought is that usually, as I don't recommend paying points right now. Instead, if you do have extra money on the table, either from seller paid closing costs, then it would make more sense to put that in towards paying all your closing costs so you can save upfront money, because you might be able to get a higher rate of return with that money in another place, in another asset. Or you can put that in a temporary buy down, which means, and that's where the interest rate is temporarily bought down for you on a year-to-year basis, depending if it's 1 year, 2 years, and I can clarify that if you need me to. But the cool thing is about temporary buy downs is any money left in that account that hasn't been used, if you do refinance, comes back to you. It's not just gone. Versus if you do a permanent rate buy down, that money's just gone. And if you refinance and you can't get that back. So it's how can we get that money to work for you, and what's the best way to utilize it. So that would be my recommendation is, talk to the person that you're using for your mortgage professional you're using, and make sure you run scenarios so you see where's the best use of your funds. Because refinancing, a stat came out last week where most people are probably going to be refinancing at least 1 to 2 times within the next 5 years. So it just makes sense to make sure you're making your decisions based off of that, and don't just spend money because you think you're getting a low rate when you might get that rate in the next 6 months without spending that money. So that's, and then also look for people that have refinancing programs as well. That would also be my second piece. I know that's something that we have, but if refinancing is most likely a high probability, it'd be great if you worked with someone that, offered some kind of benefit or program for refinancing with them to help save on costs as well.
Daphne, what are you seeing for your buyers? Like, are they asking a lot about interest rates, or are they talking about waiting until they come down? Like, what are you hearing?
Kind of everything. I have a couple groups of buyers that are like needing to buy a home. It's like your standard, like, families, we're moving here, we need to do this now. Then I've got a couple other ones that are just kind of waiting. And then I've got another group that needs to sell before they buy. So figuring out what we're doing with that and like how are we bridging that process. So it's kind of a mixed bag for me.
Do they have reactions to the interest rates? Does it make somebody make a move?
I think everybody has, it's a good question. People know interest rates are high because everybody's talking about it, and we've been talking about it for the last year and a half now. So I think folks understand that there's a high interest rate. What I feel like most of my buyers, and I'm sure you guys too, are really focused on is getting a deal, because now we can get a deal. So what's our price going to be, and how much can we get in closing costs? What else can we get the seller to pay? I guess there would be a payer at that point. So yeah, I think people, no one likes a high interest rate, but they know that it's there. So it's like, what else can we get? Is what I'm seeing.
I think that's a healthy mindset to have too. Yeah. Like finally that part's normalized. So it's like, how else can we benefit from this? Mm-hmm. So.
Yeah.
You mean a healthy mindset and the ability to negotiate?
Mm-hmm.
Yeah.
And it's like, this has allowed us as realtors to be able to do our job effectively too, because when everything was in multiple offers, like it was a different skill set we had to pull out, but there was no negotiating for our clients. It was like gathering info and just following that. So it's like, we'd call the selling party and be like, what do you need? But now we can actually negotiate and use these tools that we've had just kind of sitting on the back burner for years.
Yeah.
Do you find that fun now that you're able to do that?
Yeah, I enjoy that. Do you guys like that?
I'm of two minds. JD, what do you think?
I liked more transactions, but yeah, it's more calm. And I also feel like there's a lot more intelligent decision making you can do without the pressure. So one thing I'd like to put out there is do you like a frenzy, like a buying frenzy? Do you like being a part of that, like that herd mentality? Then yeah, keep waiting along and something's gonna bust. If not, I suggest just getting like understand the temperature of the water. And I know I've been saying this a lot, and not everybody's doing this. Like write offers, like just kind of see what's going on. It's never the wrong time for the right house at the right price for your right payments. And you don't really know unless you're shopping around. And there's so much inventory. It's like, why not take a stab at something and see? Yes, you might write a lot of offers. Yes, I think the realtor gets also pulled into that, which is fine. That's what we do, right? But I think more people are more hesitant than understanding what's going on out there. They kind of like want to see the bottom. But if you knew that was the bottom and everybody knew it was the bottom, you know it's going to go up after the bottom. And then after that, you're back in that frenzy. So just, get ahead of it, because I think something's brewing. So I would say, 2025, 2026, like position yourself into ownership and, sit tight for a couple years, and you'll probably be in a better spot, I think, in the long run.
Yeah. If Forbes knows about it, everybody knows about it.
Exactly.
Meaning,
The what you were saying about like just writing offers to see like the right house at the right time at the right price, like that could work. This is a story that I've kind of been hanging on to throughout the last like 8 months. I had a client last year who was looking at ranches in Lockhart, and we ended up getting her a $400,000 discount with all closing costs paid on a ranch in Lockhart.
nice.
Because we tried. What a freaking win.
That's awesome.
Yeah. So of course that's definitely the exception. Like we can't do that on every transaction, but we did it. We did it. Yeah. And I'm sure we've all gotten some crazy deals right now in this market for some clients in some regards. So
even builders, I feel like builders are doing pretty good deals out there.
Well, you got to ask yourself if they're able to. I think I got to pause on that. I think the way to say it is, have you ever followed how the auto industry works, like with dealerships and kind of the layers to get to people? Right? It's like there is no direct to consumer model.
Yeah.
Right. And I think that's what builders are. And that's not saying I have anything against them. I'm just saying that's not how they work. There are a lot of layers. There's developers, there's builders, there's the agents, brokers, all that. So when it comes down to negotiating things, I think a lot of times people can negotiate themselves out of an opportunity. Like it's a good opportunity, buy it. Or you can try to nickel and dime the person on the other side, and they get so frustrated that they just want to walk away. It's like, this isn't even worth it because of the stress and the headache. So I see both sides of it. And I understand that we should be able to do that, but depending on the culture, sometimes that's kind of an embedded philosophy, right? So it really just, it changes. It changes based on who your clients that you normally work with are and the market that we're in. Right now, we're in a market where I would say buyers are better off than a lot of sellers. And a lot of buyers still feel that it's unaffordable. And so they're missing out on these opportunities because they're also in a situation where they may not know that the questions to ask.
Right.
Maybe. Right. Or they could just be worried about their jobs. And so they don't want to commit to something not knowing if they're going to have to move in 6 months. I could see that too. Right. Or I've got another client / friend who he's always looking for new jobs, even though he has a fantastic job, but he's also worried that the market might take a hit because a lot of people's student debt is coming due because it had been deferred and deferred and deferred. So these are all things that I think will affect Austin, specifically Austin. But as long as we don't have major corporations coming back in and buying up all the houses again, then we should be fine. That's my prediction. As long as we don't have that happening, we should be all right.
That was such a mess.
It was a mess.
I wonder if that is going to happen again. That would be a good topic for another podcast.
Probably not. Like, what a stupid business model. Anyway,
But you can do it.
that's another goal. That's another episode, huh?
I think if you do it right, you can do it, but it would screw a lot of people over.
Lots of nuance there. Yeah, lots of nuance.
Yeah, that's like, do you want to think as the business, like, and how profitable it can be, or do you want to be like, oh, let's do what's good for the good thing, like the right thing or the good thing for everybody?
The question on either side is always, when's enough? And on the business side, it's never enough. And on the consumer side, it's like, it was enough the first time. It's really a challenging dichotomy right there, but you're right. Anyway, JJ, where are we at on time?
I think that's it. And I think we might have another episode coming regarding that. So thanks everybody for tuning in. Hope you found today's conversation helpful. We went through the real estate market, how things are shifting, interest rate cuts. If you have any questions or want to dive deeper, reach out to any of us, drop your comments, like, subscribe, and we will see y'all later. Happy buying, selling, and investing, everybody.
Thank you. Thank you, Sarah. Thank you.
Oh, thanks for having me.